Thanks for tuning in to the Lean 911 podcast, where you'll have a voice directly from the Gemba. I will rely on my 3 decades of Lean successes as well as my failures to answer your most challenging questions regarding your Lean transformation. I'm your host, Mark DeLuzio, President and CEO of Lean Horizons Consulting and the Principal Architect of the Danaher Business System. Looking forward to your questions. Now, let's go to the Gemba. Hi, Mark DeLuzio, episode 61 on Lean 911. I was asked to talk about my view on OEE, overall equipment effectiveness. And as I thought about this particular episode, I also thought about absorption accounting, because in a lot of ways, absorption accounting, which I eliminated when I developed lean accounting way back in 1989 at Danaher's Jake Break. I guess that's the first lean accounting system that was on record. We didn't call it that back then. You know, when we did all these things, we didn't put names to them. We just did what we thought was right. And I just took all the traditional cost accounting that I learned over about a decade and said, hey, this is not working for a lean transformation. All these measures, standard cost, absorption accounting in particular, purchase price variance, and I think I have another episode on that somewhere, and I'll do more about that. But I want to talk about absorption accounting in original or overall equipment effectiveness, okay? And they kind of go hand in hand. The same dysfunctional behaviors are all about that. So I titled this episode OEE and Absorption Accounting, Different Methodologies with the Same Disastrous Results. And again, when I say disastrous results, as it relates to a lean transformation. So I want to talk about that and talk about some of the things that happen when you measure people on either absorption accounting or OEE. Okay, so OEE has a lot of parts to it, okay? And I'm not going to go into all the calculations of OEE. However, I've never seen it used when it didn't drive the wrong behaviors. Also, absorption accounting. But let's just talk about OEE for a minute. OEE talks about basically uptime. I mean, when you get right down to it, I mean, it's got other parts to it, but the biggest driver on OEE is this thing called planned downtime or unplanned downtime. Okay. And you can look at this measure calculated in a couple of different ways. When you talk about downtime, you're not only talking about equipment downtime due to equipment malfunction, you're also talking about things like changeover time, or what I call SMED, single minute exchange of die, or just pure changeover. Okay. So when you look at OEE, what does it do? It promotes batch manufacturing. It does not really promote any kind of incentive. And by the way, absorption accounting is the same way, for you to do more changeovers. And I remember way back when we first learned lean from Shingajitsu and my sensei Nakao, he said, you need to do more changeovers. And we looked at him like he had 3 heads, because we were still on the Ollie White, EOQ, economic order quantity, where we try to avoid changeovers. No, DeLuzio son. The way you decide to produce is not the way your customers decide to consume. You need to match your production schedule as close as possible to your customer demand schedule. And you need to do more changeovers. But you can't do more changeovers when they're 8 hours. And we were able to get our 8-hour changeovers down to virtually 7 minutes, okay, through Kaizen and single minute exchange of die philosophies. But of course, when they're 8 hours, you can't do more changeovers. You try to avoid them, of course. So this whole thing about OEE says, hey, look, changeovers are going to kill our number. And if I get measured on OEE, well, I'm going to have a tendency to do less changeovers. Now, there's 2 ways to look at it with OEE. You can put it in as unplanned downtime, okay? And if you count changeover as unplanned, in other words, you're counting it as an abnormality, well, it's going to lower your OEE performance. So, what's the incentive? It promotes batch production. I'm going to do less changeovers, so I know that's going to hurt my number, right? What if you put it into planned downtime and you looked at it and said, well, okay, if I put it into planned downtime, it will not impact my OEE performance. Oh, that's great, right? Yeah. Now I ignore getting better at changeover. Okay. It still has the same effect one way or the other. All right. So it's not healthy in that regard. Now you can argue, okay, well, let's look. Once you set a standard for your changeover, and if you go over that, that will go into unplanned. You can play all those games. But bottom line is, OEE does not incentivize anybody to do more changeovers. I don't care how you calculate it or how you look at this. Okay. Another thing to think about with OEE and absorption, okay, you bypass your TPM standards. Now, by the way, let me take a minute just talk about absorption because I'm talking a lot about OEE. Absorption accounting basically takes the cost of manufacturing and puts them in inventory. When you take the cost of manufacturing with in terms of labor and overhead and put them into inventory, into the inventory dollar bucket on the balance sheet, that is a massive credit to the profit and loss statement. So if I only spend $1 million in actual overhead expenses, but I absorb through my standard cost system $1,200,000 and put that into inventory, I start the month off with a $200,000 profit without having sold a single unit. Okay. So you get a lot of chief financial officers say, hey, make more. Make more. We got to put more stuff into inventory because it's going to hit our bottom line if we don't. And we want to capitalize as much of our inventory of our production costs as possible. So let's just make more. Well, that has the exact same effect as OEE. Exact same effect. It doesn't promote more changeovers because when you change over, you take away from putting inventory, putting product into inventory. All right. So same exact effect. It's just coming at it from a different angle, from a financial angle. All right. It doesn't promote. It doesn't promote more frequent changeovers. Which, by the way, more frequent changeovers means that you're going to make smaller batches and you're going to be more productive in terms of lead time, shorter lead times, and better on-time delivery. Now let's just think about this. If I look at more changeovers, or let's say I don't do I don't do more changeovers, but I produce in larger batches, and I produce in batches of let's say 1,000 when I should be producing in batches of 100. I just stole the 900 units of capacity from something that could be sold. That's another way to think about this. When you produce in batch, you are stealing capacity from what needs to be sold by producing that extra 900 and put it into inventory. And a lot of financial CFOs don't get this. They don't understand. All they're looking at is the bottom line profits. Sooner or later, that inventory has to come out and either be sold, and it will hit your cost of sales as an expense. And sometimes when it comes out at a discount because we have to fire sale it. We have too much and we have to discount it. Or it comes out as obsolescence and we have to write it off. All right. It's pay me now or pay me later. So you can, try to continue on this. And I'm not even talking about the negative cash flow implications because when you spend a lot of money and build inventory that you can't sell, you are impacting your cash flow, which means you have to borrow more money to finance the business. Okay. Again, OEE and absorption have the exact same dysfunctional behaviors, promotes the exact same dysfunctional behaviors. Now, let's talk about productive maintenance, total productive maintenance. There's less tendency to shut down and do TPM activities for the exact same reason that there's less incentive to shut down and do more frequent changeovers. Exactly the same problem. Well, what ends up happening? Your equipment starts breaking, okay? And you're down anyway. And that's not a good thing, right? So think about that. Think about quality now. All right. Many times with OEE and with absorption, there's a tendency to run the equipment faster than what is recommended engineering wise. All right. So you're going to run faster than your your engineered cycle time just so you can get more product out in a shorter amount of time. I remember some drill presses that we had that the operators would put cheater bars on them so they can get a faster drill as they pull down. However, it impacted the quality of the part. All right. Now, what's the other quality problem here? There's a tendency to pass bad parts on to the next process. Yeah, I know those are defective, but you know what? I need to count them in my OEE calculation or in my absorption. So I'm going to transact these parts as good parts, and pass them on to the next process. Because many times we're looking at, you know, end of line first pass yield. We're not looking at in process quality when we do this. There's no incentive to do that. So another quality problem here is that we're not looking at in process quality, looking at end of line rejects, and we kind of turn the other way on questionable quality. Yeah, let's just pass it on to the next guy because I need the credit. Maybe he's going to have to reject it in the next department, in the next operation. But yeah, we're going to kind of look the other way and send those parts down the line so we get production credit. So you see, all these things from a TPM perspective, from a changeover perspective, from a lead time, from a quality perspective, and if you go back to the hierarchy of safety, quality, delivery, and cost, most of the time OEE and absorption is driving the bottom rung metric on this, which is cost. And that's a hierarchy, SQDC. Cost is the last one on the matrix, okay? The least priority. As a matter of fact, most of those safety, quality, and delivery, and lead time, if you will, drive cost. Cost is a lagging indicator. But we go after that cost first and we suboptimize quality and delivery, okay? And again, delivery being lead time as well, right? So go back to the principles of SQDC. Why am I jumping to try to optimize C when I'm compromising Q and D? And in some cases, you might be compromising safety as well. Okay. So that's something to think about. Now, let me tell you a couple of stories. I was at a client down in Arkansas, and I've talked about this on other podcast episodes, but I'm going to repeat it again. And I'm walking with the CEO of this multinational company and the CFO. And I asked the CFO, how do you compensate people here in the factory? He said, everybody gets paid on machine uptime. I said, oh, that's interesting. Well, why do you do that? He said, well, we paid a lot of money for this equipment and we have to get our return on investment, ROI. You probably heard that before. We have to get our ROI. Oh, interesting. Okay. By the way, this company I already knew wasn't producing, they were producing in batch. They were actually losing business because of poor delivery. Okay. Producing a bunch of A's when they also had orders for B's, C's, and D's. All right. Obsolete inventory, excess inventory, they had quality problems, they had lead time problems, they had cash flow problems, all because of this one metric. They weren't doing preventive maintenance on the equipment, and they certainly weren't changing over from Model A to Model B to Model C and so forth. Okay. All the ills. So I looked at the CFO, and he had just happened to tell me the day before that he bought a brand new Lexus. Okay. So I said to him, "Hey, by the way, you just bought a new Lexus. You told me, right?" He goes, "Yeah." I said, "It's a nice car. I mean, it was a quality car, it's good resale value and all that. Costs a lot of money, though, right?" Yeah, they're a little bit more expensive than some of the other models I looked at. Okay. Well, since you paid a lot of money for this investment, I'm sure you want to get a good return on your investment. When you go home tonight, are you going to drive that car around the block, I don't know, a couple hundred times just to get quote unquote utilization out of your vehicle? He said, well, why would I do that? I said, I haven't the foggiest idea. You're doing it here. Okay. So I got to assume that you're going to be doing it in your own personal life with your own investment. You want return on investment, don't you? God, he said, I never thought about it that way. Well, come on. Don't you want to get ROI? And I looked at him and said, you can't go to the bank and cash in ROI. And all this equipment that you look, I'm not saying to be foolish with how to utilize your equipment, but it's a sunk cost. And to think that you're going to get that back is foolish. It's a sunk cost. Sunk cost means you spent it, you can't get it back. Okay? That's an accounting principle, by the way, that sometimes accountants seem to forget. And again, I am by no means telling you to be foolish on how to utilize your equipment, but you're optimizing this thing called C, cost, on the SQDC matrix when you should be looking at quality and delivery performance and lead time. All right. Which drives business growth, by the way. The whole thing drives business growth. So when you look at this whole thing, and the light bulb went on in his head. He said, "Yeah, I never thought about that way." Yeah, try to go down to the bank and cash in ROI. See what the bank teller tells you when you go down there. Okay, so true story, and got them to think differently about how they're measuring people in the factory. All right, because all their bonuses were tied to that. Now let's just talk about absorption. If you have a lot of inventory and you start a lean transformation, and this is where a lot of people go wrong with the financial part of this. When you take inventory down, similarly, when I told you that when you put a lot of inventory into your balance sheet and build inventory, it's going to have a positive profit effect on your profit and loss statement. Conversely, when you take inventory down and reduce your inventory, it's going to have a negative effect on your profit and loss statement for the time being, anyway, until it gets to a certain standard level that you're going to be running the business with. It will have the exact opposite effect. You'll get negative profit and loss statement. So, in other words, if you spend $1 million, put $1 million into inventory. Let me take that back. Let's say you spend $1 million on cost of production, but you only put 800,000 into inventory, and the rest you sell immediately with zero lead time. That 200,000, you're gonna have a negative $200,000 start to your month. You're gonna have a negative loss on your profit and loss statement. But at the end of the day, it's just funding money. It's just accounting losses. They're not real losses. As a matter of fact, when you look at cash flow, you're coming out a winner. So when I first became CFO for Jake Break, for George Konensaker and Art Byrne, we were doing all kinds of great stuff with lean at Jake Break. And again, we were the first company in Danaher to. That's where the Danaher business got its start. And the Rails brothers called up and said, "Hey, we need to come in and see what's going on at Jake Break because your accounting profits are really taking a hit." And we were just taking inventory down like you wouldn't believe. We went from like 2 inventory turns to like 25 turns in a matter of, I don't know, 12, maybe less than 18 months. So we were taking a real big hit on inventory, right? So the Rails brothers flew down, multi-billionaires. They flew down on their jet, and I had to give a presentation to these guys. I'm saying, okay, geez, I'm a young CFO, right? And I got these multi-billionaires, and we want to know what's going on with your P&L, your profit and loss statement. And I showed them the cash flow statement and explained the whole absorption factor to them. I said, look, we are generating cash like you wouldn't believe. All right. And that's what really matters in a business. I don't care if you're a public company or a private company or if you're an entrepreneur. I think if you're an entrepreneur, cash flow is king, right? And I showed them the whole cash flow effect and told them, hey, look, once we get down to what we think is going to be the standard inventory to run this business, not to say we can't make more improvements, but this is going to level off. And then everything else is going to be gravy. But I looked at him and I said, these accounting profits that are reported to Wall Street are BS numbers anyway. There's so much crap. There's reserves in these numbers. There's all kinds of, accounting accruals and things like that. The accounting profit and loss does not really reflect the true running of the business. And so many CFOs will disagree with me. Okay, at least in the short term. All right, but we're generating cash like crazy. You don't want me to build inventory, do you? They looked at it and said, you know what, we got it. They're smart guys. They got it. Mitch and Steve Rails, they got it. They did a factory tour, left the building, got on their plane, and went home. And they were happy. They were satisfied. Okay. But there's a lot of businesses that don't understand this, and a lot of CFOs that, if they do understand it, don't know how to explain it. Okay. It's all about cash flow. All right. So, just another example of of uh, of what happened here. So, to summarize, overall equipment effectiveness, OEE, and absorption accounting drive the wrong lean behaviors. I don't like those measures. Every time I see them put in, I have not yet seen it drive the right behaviors. Ever. Ever. Okay. Now, you may sit there and say, no, no, we use it the right way and we don't have this problem. Okay. My next question is, how many changes were you doing 6 months ago and how many are you doing now? That's my first question I'm going to ask you. And if the answer is it hasn't changed materially, then guess what? It's driving the wrong behaviors. Okay. Or conversely, I may ask you, what would you change over 6 months ago and what's it today? Was it 8 hours? What is it today? Yeah, it's still around 8 hours. Okay. I rest my case. I absolutely rest my case. All right. Let me see your maintenance logs. Let me see your equipment downtime. Has that improved significantly? Hasn't? Okay. Again, I rest my case. And so forth and so on. Right. So these are the things I want to talk about with OEE and absorption. They both, like I said, drive the same negative, dysfunctional, lean behaviors. Now, you might say, okay, well, Mark, what would you do? The measure I like, and again, any one measure, you have to understand, you could play games with, all right, and you can always beat a measure. So I'm not saying the universe is going to be beholden to this one measure I'm going to show you, but I like this measure better because I think it drives the right behaviors if you use it correctly. And it's called, and I'm going to show it to you here on the screen. It's called Tech Time Performance Measurement. Now, if you're listening to this on Spotify or on Apple Podcasts or some other media, and you're not looking at this on YouTube or Rumble, you might want to pull up the YouTube video to take a look at this slide. It's called Tech Time Performance Measurement, I'll give you my email at the end of this, and I'll be happy to send you this slide. Okay, it is taking the actual good parts, emphasis on good. That means quality. Okay, actual good parts produced in the available time that you used to calculate your takt time. Okay, divided by the total planned demand per that available takt time. That equals your takt time performance attainment percentage. Okay, so for example, if you planned on producing in your given available time, and again, you take your shift time, less your breaks, and less your meeting time, and things like that, right? And you come up with your available time. In that particular time, if your daily demand was 100 units, okay, but you actually only produce 88 units in that given time frame, your tech time performance is 88%. Okay, simple as that. My daily demand was 100 units. I only produced 88 in the available time I said I was going to produce it in. My tech time performance attainment is 88%. Now, question: what if what is the tech time performance if the 12 units are made up using overtime? So, in the very same day, you work an hour overtime, let's say, and you make up those 12 units. Does it go back to 100%? No, it stays at 88 because your standard was you needed to do it within the available time that you use to calculate your takt time. So overtime is looked at as an abnormality. All right. So no, it's still 80%, 88%. It doesn't go to 100% just because you made up the units. And you should make up the units. Otherwise, tomorrow you're going to have to make 112 units. Okay. And you're going to short some customer out if you continue that kind of practice. Right. Now, on this chart, I circled the 12 units and I pointed to a Pareto diagram that says, hey, look, we should start looking at the shortfall based on this calculation and use that on a Pareto basis, on a priority basis, to figure out what our next Kaizens are going to be. So, for example, over the course of time, I look at these misses 12 units today, 8 tomorrow, 15 the next day, and I say to myself, you know what? What's the biggest reason for that? Oh, it's machine downtime. Okay, which machine? Oh, 80% of it is on machine number 42. Okay, let's go to machine 42 and figure out what's going on. Or it could be that I had material problems. Oh, which materials? Oh, it happened to be the collet that we got from supplier. Which supplier? We got it from supplier A. Let's start looking at the supplier performance and understand why the supplier is shorting us. It could be some things internally in terms of our Kanban signals to the supplier. It could be a supplier performance issue. It could be that the purchasing department is buying in bulk to get great lower cost because of volume, which is a violation of just in time. And he's stealing capacity from our supplier because now the supplier is making collet A, but we need collet B for the production, and he shorts us on B. You see how this works? Stealing capacity, all this stuff ties in. What's another reason that we could have a problem? It could be a quality problem. Hey, we had to scrap a bunch of units on Operation 3. Okay, well let's understand what that looks like. What kind of scrap is this? Where did it happen? That's what Pareto's all about. You keep driving Pareto down. Once you find out what the bigger category is, you keep driving it down. Okay, so there could be all kinds of different reasons why we are missing our performance to takt time. Okay, so I like this. I like this measure better. All right, because it really ties you into customer requirements. Okay, so the 100 units that we're talking about that's in the denominator of this equation happens to represent, it should represent, through your PSYOP process and your production planning process, it should represent your actual demand that's required in a just-in-time fashion. All right. So that's the measure I happen to like. And again, I could send you this slide if you want, and I'll give you my email at the end of this. So here we are, takt time performance, but again, the ills of OEE and absorption accounting. Again, I've been asked to do OEE, and I thought I'd throw in absorption too because it's exactly the same problem, just coming from a different part of the organization. All right. Feel free to email me at mark, M-A-R-K, at lean911.com, and I will be happy to send you that slide. And if there's any questions, please email me and let me know what you'd like me to talk about. All right. We'll see you next time. This was episode 61. Mark DeLuzio for Lean 911 and Lean Horizons Consulting. Appreciate it. Thank you. See you next time, and stay lean. Thanks for listening to the Lean 911 podcast. I'll be happy to address your questions or feedback on future episodes. Email me at mark@lean911.com. You can check out our other episodes by visiting our website at lean911.com, our YouTube channel, wherever you listen to podcasts. This is your host, Mark DeLuzio. Thanks for listening.